In trade finance, insurance plays a critical role in mitigating risks related to international trade transactions. The legal and contractual aspects of insurance in trade finance are essential in ensuring that parties involved are protected against potential losses due to various risks such as non-payment, goods, damage, or political instability. Below are the key legal and contractual aspects. 1. Insurance policies. Types of insurance. The most common insurance policies in trade finance include marine insurance covering goods in transit, credit insurance protecting exporters from non-payment by buyers, and political risk insurance covering losses due to government actions or political instability. Policyholders. In trade finance, the insured parties are typically the exporters, importers, or financial institutions involved in the transaction. Coverage. The policy should clearly define what is covered, including the risks, for example, insolvency of the buyer, default, war, or expropriation, and exclusions, for example, intentional misconduct or poor quality of goods. 2. Contractual obligations. Parties to the contract. The insurance contract typically involves the insurer, the insured party, and sometimes third parties like financial institutions or freight companies. Premium payment. The contract specifies the payment obligations for the insured premium payments, which must be met to ensure the coverage is valid. Claims process. The legal framework includes the procedure for filing claims, including timelines, required documentation, for example, bill of lading, invoices, and the assessment of losses. 3. Insurable interest. Insurable interest refers to the legal right of the insured to obtain insurance coverage. In trade finance, this usually applies to parties who stand to suffer financial loss if the goods or payment are not delivered as agreed. Insurable interest is critical in determining the validity of the insurance policy and the enforceability of claims. 4. Subrogation rights. When an insurer pays a claim, they often gain the right to step into the shoes of the insured to recover the loss from third parties. This is known as subrogation in trade finance. This might involve the insurer seeking reimbursement from the party responsible for the loss, for example, a defaulting buyer. 5. Letter of credit (LC) and insurance. In trade finance, letters of credit (LCs) are commonly used as a form of payment guarantee. Insurance is often a condition of the LC to protect the financial interest of the issuing or confirming banks, ensuring that goods are insured while in transit. The LC contract will stipulate that insurance coverage meets specific requirements such as coverage amounts, types of risks covered, and the nomination of the beneficiary. For 6. Applicable law and jurisdiction. Insurance contracts in trade finance may involve parties from different countries, leading to complexities in determining which legal system governs the contract. International trade agreements, such as those governed by the International Chamber of Commerce (ICC) rules, for example, Uniform Customs and Practice for Documentary Credits (UCP 600), often specify the governing law and jurisdiction in case of disputes. 7. Compliance with international regulations. Insurance contracts must comply with international trade laws and regulations, such as economic sanctions or export control laws, which can affect the enforceability of the insurance contract or the insurer's ability to pay claims. 8. Risk mitigation clauses. Force majeure. Insurance policies often include force majeure clauses, which exempt the insurer from paying claims for losses arising from extraordinary circumstances, for example, natural disasters, war. Warranties. Many insurance policies in trade finance require the insured to comply with specific warranties, e.g., maintaining goods in proper condition to avoid invalidating the coverage. 1. Examining the legal implications of insurance in trade transactions. Examining the legal implications of insurance in trade transactions involves understanding the legal responsibilities and risks that are distributed among parties involved in the trade. Insurance in trade transactions primarily aims to mitigate risks such as loss of or damage to goods, non-payment by buyers, and unforeseen political or economic events. The legal implications can vary based on jurisdiction, the nature of the transaction, and the types of insurance policies used. 1. Risk allocation and transfer. Primary purpose: insurance in trade transactions primarily serves as a risk transfer mechanism. The legal implication here is that the insured, typically the exporter or importer, transfers specific risks to the insurer in exchange for payment insurance premiums. This allocation of risk reduces the liability of the insured in case of a loss. Transfer of ownership and risk. The terms of the sales contract, for example, under Incoterms, determine when the risk passes from the seller to the buyer. Marine insurance, for instance, covers goods in transit and is aligned with the risk transfer terms stipulated in the contract. 2. Insurable interest and legal standing requirement for insurable interest. In order for an insurance contract to be legally enforceable, the insured party must have an insurable interest in the subject matter of the contract. In trade transactions, this means that the insured must stand to suffer a financial loss if the goods are damaged or lost. Legal consequences: if the insured party does not have an insurable interest at the time of the loss, the insurance contract can be deemed void, and any claims made under the policy will be rejected. This requirement ensures that insurance is not used for speculative purposes. 3. Legal interpretation of coverage. Disputes over scope of coverage. A common legal issue in trade transactions is the interpretation of what the insurance policy covers. For example, disputes may arise over whether a particular type of loss, for example, damage due to improper packing or delays, is included under the policy. Legal disputes can also arise over exclusions in the policy, such as coverage not applying in certain jurisdictions or in the case of specific types of loss. Duty of disclosure. The insured party must disclose all material facts that could influence the insurer's decision to provide coverage. If there is a failure to disclose or a misrepresentation of material facts, the insurer can legally refuse to pay the claim or cancel the policy. 4. Contractual obligations and breaches. Obligation to pay premiums. Failure to pay insurance premiums can lead to the termination of the contract, leaving the insured without coverage. In trade finance, failure to maintain insurance coverage could breach contractual obligations to lenders or buyers, leading to legal consequences such as contract termination or claims for damages. Compliance with contract terms. The insured must comply with the terms of the insurance contract. For example, if a policy requires certain storage conditions or specific methods of transport, non-compliance could result in the denial of claims. This creates a legal duty on the insured to adhere to contractual terms, and failure to do so can result in litigation. 5. Subrogation rights. Legal right of insurers. When an insurer pays a claim, they may gain the right of subrogation. This means the insurer can step into the shoes of the insured and pursue legal action against third parties responsible for the loss. For example, if goods are damaged due to the negligence of a shipping company, the insurer may sue the shipping company for the amount paid to the insured. Implications for the insured. The insured must cooperate with the insurer in such actions, or they could be legally liable to repay the insurance settlement. Subrogation clauses in the insurance contract govern this aspect. 6. Jurisdiction and applicable law. Cross-border legal complications. In international trade, the parties may be based in different countries, and the insurance policy may be governed by the laws of a specific jurisdiction. The legal implications here include potential conflicts of law, where the governing law of the insurance contract may differ from that of the underlying sales or financing agreement. This can lead to disputes over jurisdiction or the applicable legal framework for resolving issues. Arbitration and legal dispute resolution. Many trade finance insurance contracts include arbitration clauses, specifying that disputes must be resolved through arbitration rather than litigation. Arbitration offers a private and often faster way to resolve disputes, though the decision is binding. The choice of arbitration versus court litigation has significant legal implications for the resolution of disputes. 7. Force majeure and political risk impact of unforeseen events. Force majeure clauses in insurance contracts address circumstances where external, Unforeseen events such as war, political upheaval, or natural disasters affect the insured transaction. In some cases, insurance policies include coverage for these risks, but in others, these risks are explicitly excluded. Legal repercussions. The occurrence of a force majeure event may relieve one or both parties from their contractual obligations. In international trade transactions, political risk insurance may cover losses caused by government actions, such as expropriation or restrictions on currency convertibility. Failure to have appropriate political risk coverage can leave parties exposed to significant legal and financial risks. 8. Sanctions and compliance. Regulatory compliance. Insurance and trade transactions must comply with international sanctions and embargoes. The legal implications are severe if insurance policies are used in transactions involving sanctioned countries or entities. Violations of sanctions can lead to legal penalties, including fines or imprisonment for both the insured and the insurer. Claim denials due to sanctions. Insurers may legally refuse to pay claims if the trade transaction is found to violate sanctions or other regulatory restrictions. Therefore, ensuring that the transaction complies with relevant legal frameworks is crucial. 9. Credit, insurance, and non-payment. Legal framework for credit insurance. In the context of trade finance, credit insurance covers the risk of non-payment by the buyer. This type of insurance has legal implications for both the insurer and the insured. For example, disputes may arise over whether non-payment was due to a legitimate credit risk or fraudulent activity. Role in financial contracts. Credit insurance is often a condition for financing from banks or other financial institutions. If credit insurance is not in place, or a claim is denied, it could lead to default on financing agreements, triggering legal actions like foreclosure or bankruptcy proceedings. Conclusion. The legal implications of insurance and trade transactions are extensive and involve the interpretation of contractual terms, compliance with regulatory requirements, and managing disputes over claims and coverage. Careful drafting of insurance policies and adherence to legal and regulatory frameworks is crucial in ensuring that parties involved in trade transactions are adequately protected from risks. Drafting and interpreting insurance clauses in contracts requires precision and a deep understanding of both legal and insurance frameworks. Insurance clauses are critical in managing risk, allocating responsibility, and ensuring that the parties to a contract are adequately protected from potential liabilities. 1. Importance of insurance clauses. Insurance clauses dictate which party bears the risk of loss and what type of insurance coverage is required. These clauses are prevalent in various contracts such as construction, real estate, and commercial agreements. They ensure that risks like property damage, personal injury, and professional liability are covered by insurance rather than leaving parties exposed to financial loss. 2. Common types of insurance clauses. Indemnity clauses. These shift liability from one party to another, usually requiring the indemnifying party to cover any losses or damages. Liability insurance clauses. These require a party to obtain general liability insurance, covering damages from injuries or property damage arising during contract performance. Waiver of subrogation. This clause prevents an insurer from pursuing the counterparty for damages after compensation has been made to the insured party. 3. Key drafting considerations. Clarity of terms. Vague language leads to disputes. Terms like reasonable or adequate must be well defined. Coverage limits. Specify the amount of coverage required and confirm that it matches the level of risk involved. Additional insured provisions. Ensure that all necessary parties are included as additional insureds to protect against third-party claims. Duration of coverage. Clearly outline the time frame for which the insurance must be maintained, including any post-contract obligations. 4. Interpretation principles. Courts interpret insurance clauses based on plain meaning and the intent of the parties. Ambiguities are often construed against the drafter, so precision is essential. The scope of coverage is a frequent point of dispute, especially regarding exclusions or limitations of liability. 5. Common pitfalls. Over-reliance on standard forms. Standard clauses may not account for the specific risks of a transaction. Misalignment with regulatory requirements. Ensure the clause complies with legal requirements in the relevant jurisdiction. Failure to monitor compliance. Regularly check that required policies are in place and up to date throughout the contract period. Conclusion. Effective drafting and interpretation of insurance clauses safeguard parties against unforeseen risks. Clear, detailed, and context-specific language is essential to ensure proper risk allocation and avoid costly litigation. 3. Understanding the contractual relationships among insurers, banks, and exporters involves grasping how these entities interact to manage risk, facilitate transactions, and ensure financial stability in international trade. Here's an overview of their roles and relationships. 1. Role of insurers. A. Insurance coverage. Insurers provide various types of coverage to exporters, including export credit insurance. Protects exporters against the risk of non-payment by foreign buyers due to commercial or political reasons. Marine insurance. Covers loss or damage to goods during transit by sea. B. Risk management. Insurers assess and manage the risks associated with international trade, offering policies that help exporters mitigate financial losses. 2. Role of banks. A. Trade financing. Banks offer trade finance solutions such as letters of credit LCs, guarantee that payment will be made to the exporter once the terms of the LC are met. Export loans. Provide funding to exporters to cover costs before payment is received. B. Risk mitigation. Banks collaborate with insurers to offer products like export credit guarantees. Banks may require insurance coverage to back their financing, reducing their risk exposure. 3. Role of exporters. A. Export agreements. Exporters enter into contracts with foreign buyers and often need insurance and financing to fulfill these agreements. They obtain insurance to cover risks related to non-payment, damage, or loss. Secure financing to manage cash flow and ensure they can fulfill orders. B. Compliance. Exporters must ensure that they comply with both insurance requirements and the conditions set by banks for financing. 4. Interactions and relationships. A. Exporter-insurer relationship. Exporters purchase insurance to protect against risks in international transactions. Insurers provide coverage based on the terms agreed upon in the insurance policy. B. Exporter-bank relationship. Exporters seek financing from banks to manage working capital and ensure liquidity. Banks might require insurance coverage to secure their loans or LCs, thus protecting their interests. See bank-insurer relationship. Banks and insurers collaborate to offer comprehensive solutions for exporters. For instance, risk sharing. Banks may rely on insurers to cover risks associated with export finance. Product integration. Banks may integrate insurance products into their financing solutions, ensuring that exporters are adequately protected. 5. Example scenario. Consider an exporter shipping goods to a foreign buyer. Insurance. The exporter purchases export credit insurance to safeguard against the risk of non-payment. Bank. The exporter arranges for a letter of credit from their bank to ensure payment upon meeting the terms. Insurer. The insurer provides coverage that backs the export credit, which can help the bank feel secure in extending financing.